Okay guys, let's quickly go through Kamila Company. During the year, the company signed consulting contracts totaling $30 million. Let's think about us ordering a soccer ball from Amazon for $10. On Wednesday, I order the soccer ball and I give them my credit card information. On Thursday, I regret my purchase of the soccer ball and I cancel the order. That's the end of it. They haven't charged me, and so they don't need to refund me. Same concept with this contract. We decided to draw up a contract and we agreed to work for them. In Amazon's case, they agreed to send us a soccer ball. But when we canceled the contract or we canceled the order for the soccer ball, nobody owes anybody money because no obligation's been fulfilled. Amazon hasn't sent the soccer ball. We haven't done any work on those contracts for $30 million yet. A, no money. B, during the year, the company completed work on consulting contracts. However, we completed work, we completed an obligation, so we deserve to get some money. The question here is, did we get cash? No, unfortunately we didn't, but we do have an asset. Because we completed work, we know that we got revenue of some kind. Unfortunately, revenue is not an asset. That actually goes under owner's equity, which is following right here. Revenue. Because we completed an obligation, we deserve $20 million in revenue. The question is it a debit or a credit? Revenue, if you guys remember, here you guys go. Revenue. Credits mean you go up, debits mean you go down. So revenue is going up 20 million, it's a credit, 20 million. Okay, so every time we have a credit, we also need a debit. What did we get? Well, the company owes us money. This definitely isn't a liability for us, it's a liability for them, which means money for us. That isn't coming in cash, but it is coming in accounts receivable. That's money that our clients owe us and they haven't paid cash yet. Easy way to remember this is a credit, so we need a debit. The other way to remember this is that because our clients owe us money, that's good. We're gonna get money at some point in the future. That's a debit because it means that our assets are increasing. 20 million. Now, if you'll note, you'll also see that we completed 40% of work on the additional 10 million. That means that there's the same situation for another 4 million. We deserve 4 million in revenue. We didn't get that in cash, but we can put it under accounts receivable and say that company A needs to pay us another 4 million. Okay, that's the end of B. C, we collected cash for 13 million. That's great. It just told us we collected cash. So I know that I need another asset T table. Here we go. Debits and credits. Debits mean that assets go up. Credits mean it go down. Our money just increased, which means that our cash just increased. So we should make it a debit. 13 million. There we go. Now we have a debit. Where's our credit? If you paid attention, you noticed in problem B that we didn't get cash. They just simply owed us money. And in C, it never says, hey, you completed the work, you collected cash. It just says we collected cash. So it hasn't mentioned any work. We can assume that we've already completed the work and that we charged them under AR and we've already counted for revenue. So now we have this debit. Where's our credit? AR. In other words, our clients had an obligation to pay us, but now they don't. So we're going to go ahead and remove that obligation by crediting AR. D. On January 1st, the company purchased specialized engineering computers for 15 million cash. That's awesome. It was a really clear statement. So we know that our equipment just increased by 15 million. Again, we're in the asset accounts and it just increased, so we're debiting it. Now we paid for it with cash. So our cash is going to go down 15 million. A really great way to handle these problems, if you see them on the test, is to say, okay, first of all, what did I get? Second of all, what did I lose? Third, what did somebody else lose or gain? So here, in the case of D, we gained equipment, we lost cash. That helps you figure out what accounts you need to pay attention to. Okay, E. Kamila Company signed a 5-year endorsement contract with Yao Ming. Yao Ming has agreed to let us use his photograph for 5 years, and he was paid ahead of time for all 5 years, that $5 million. What's going on here? This one is a little more complicated. But first of all, we can see that he was paid $5 million in advance. So unfortunately, we just lost another $5 million cash. That's our credit. Where's our debit? Prepaid expense. This is going to be really important to remember. I know that at the beginning it can seem like a lot of different accounts, but soon enough it'll just kind of become clear as you realize what the common accounts are. You've probably already realized that like AR, notes payable, cash, equipment, prepaid expense, different things like that. Those are really popular ones that we've been using. Prepaid expense, it's good for us. We lost $5 million in cash, but we got $5 million in prepaid expense. In other words, if next month we say, hey, Yao Ming, we don't actually want that deal anymore, we could get a lot of our money back. And so that's why it's an asset. Okay, technically you're done, but we do want to go ahead and look at D and E again because on December 31st, we have to worry about expenses. First, you'll see depreciation expense. You saw the $15 million that we paid, and unfortunately, it's depreciating quite a bit over the next 3 years. 15 million divided by 3, that's going to be 5 million a year. And so we go over to OE. We have revenue here. What's happening to our expenses? Let's go ahead and take care of that. Depreciation expense. That's a T account. What do expenses do to retained earnings? Expenses decrease retained earnings. In other words, it's going to do the opposite of revenue. So when we increase an expense, it's going to be a debit. When we decrease an expense, that's a credit. Here we know that we have to expense $5 million for our technology. Really easy way to explain this. We're going to cut out a middle step for right now, but I'm hoping to explain this to you guys maybe in another video. Or at least in class this next week. It's just going to make it simpler for you guys, and I want to make it as simple as possible because this is just a review for class 6. When we expense $5 million, what's going down? The value of our equipment. As I said, this is a very simplified response, but we can say that our equipment went down by $5 million. It's only worth $10 million now. Same thing with Yao Ming. At the end of the year, we owe him $1 million. Technically, he's fulfilled the obligation, but remember, we've already paid him. That comes in a prepaid expense. So we go ahead and expense it by $1 million and say, oh, you know, we owe Yao Ming a year worth of salary, which is $1 million. We only have $4 million left in prepaid expense. When there's a prepaid expense and we're getting rid of it, you know that has to be another expense. So we go back over to owner's equity and we see that maybe this is like an advertising expense. You could call it the Yao Ming expense, like whatever you want to call it. Advertising expense. This is a credit, so we have to have a debit. Thankfully, that makes sense because when we expense things, they go up, right? So when expenses go up, it's a debit. When expenses go down, it's a credit. Okay, that is your simplified response to the Kamila problem. Hopefully you guys have a bit of a clearer idea about what's happening, especially when it comes to that cash basis and accrual basis. You can definitely see where that ties in to the slides because right here is our cash account. And after accounting for all of that, you had 13 million positive, but we unfortunately used $20 million in cash. That's how we ended up with $7 million loss. So as you guys remember, cash, we want to stay on the left side, the debits, because debits mean that cash is going up. credits mean it's going down. When we end with a $7 million credit, that means that we're $7 in the hole. So we've lost $7 million in cash. We've used it up. When it comes to the accrual basis, remember you guys that you had the net income. So net income is calculated by revenue minus expenses. Here's our revenue. You know that we have 24 million, and then we have two expenses, 5 million and 1 million. 24 minus 6, that's going to be your 18 million in net income. And then, because we don't have dividends here either, technically 18 million in retained earnings. There you guys go. Quick response to hopefully several of your questions. If I didn't answer your questions, definitely send me an email or contact the online TAs. Thank you guys.